It is 7 o'clock, so for those of you who are here, thank you very much for being on time. We're just going to give it about another minute or two and let people trickle in. But we will be getting started in the relatively near future because we do have a lot of information to go over. So just sit tight and we'll be starting in about 2 minutes. If you're listening to the recording, this presentation is being done on October 1st. So the day October 1st, it's a very interesting one, right? It is the end of it's the beginning of a fiscal year for the federal government, and it's unique in the fact that it's the beginning of the first full year of a new administration, an administration with far different fiscal policies than the past one. So that right there makes today a very interesting day. But combine that with the fact that, the federal government is in the process of furloughing 23% of the federal workforce, and combine that with the fact that we are dealing in a situation where there are additional items at play. It just rounds out the year that we've had so far year to date. Because year to date, what we've had is mass probationary firings, collective bargaining restrictions, removal of the National Labor Relations Board, accelerations of performance improvement plans, Schedule F, revoking certain protections of employment, internal drawdowns, hiring freezes, the legislation that's been all over the news, which is the big, beautiful bill, otherwise known as the reconciliation bill. And then we have the government shutdown. And we combine that with the voluntary retirement. And then we combine that with the involuntary retirement, or the RIFs, as they describe it. There's a lot of moving parts here. And one of the things that we have found is very, very smart people can make very bad financial mistakes because of emotions. And there's a lot of emotions circling around in the marketplace today around the federal government. And that involves around uncertainty and all of the items that you're working through in your careers, in your personal life, trying to figure out what's going on. So one of the purposes of today is to talk a little bit more about, okay, let's break it down to simplistic chunks. Let's talk about what we really need to talk about. And let's talk about politics, not to determine which one's right and wrong, but more so to talk about, okay, this is what's happening. This is the place that both parties are coming from. And let's look at what that's going to lead into the future. And let's make smart decisions accordingly. Because at the end of the day, a financial plan, it really hasn't changed. There's just some additional nuances to the financial plan that we didn't have last year. And those nuances are well, as a federal employee, your job may not be quite as secure as it was last year. As a federal employee, you had access to maybe some carrots that were dangling, whether it be the VERA, the DSR, the VISP, frankly, giving you alternative means to retire early with no penalties. So now that we have this, it just adds to the financial plan just a little bit. But the key really is understanding from a financial planning perspective what the average federal employee is working with. Your pension, your Social Security, and your investments, which for most federal employees, the majority of your investments are tied up in the thrift savings plan and a personal residence. So as you can see, I do this presentation quite often, and for the last 10 years, this slide in some capacity has been in every single one of my presentations. A financial plan's a financial plan. The pieces are the pieces. Now, every person's going to have unique nuances because their pieces are going to be bigger. Those old pension people, and I believe there's a couple on this call, the CSRS employees, are going to have much bigger pensions, much smaller investments. But the key is getting everything working together in the best capacity possible in order to give you the financial security, the financial plan, the financial goals that you're hoping to achieve throughout the course of your career. All right, so let's quickly talk about VERA. So again, this is one of those carrots that were dangled out in front of the federal workforce. At first they got rid of probationary employees, and then they started offering opportunities to retire early without penalty. One of those opportunities is what people used to call the early out, or VERA, the Voluntary Employee Retirement Activity. In order to get that, you needed to pass certain thresholds. You needed to be age 50 and 20 years of service, or just straight 25 years of service. And the key is you cannot take another civilian federal job, but you are able to retire early with no reduction in pension, immediate coverage for health insurance, which is subsidized, for those of you who don't know, about 72% this year, could be as high as 75%, so it's very valuable. And it allows you to maintain FEGLI if you so choose. Now, one of the things that a lot of people ran into that we've talked to over the last couple of months is if you retire before the age of 55, you cannot access your thrift savings plan until age 59 and a half. If you retire after age 55, you can access your thrift savings plan immediately. So it's a bit of a nuance that people need to be aware of. 54 years, 364 days, you have to wait basically a full 4.5 years longer to access your TSP with no 10% penalty. 55 years of age in 1 day, you can take it immediately. Now, there are ways that you can access that money earlier. It's what's called Rule 72T. 72T basically says that I'm going to take equal periodic payments until I reach age 65 and 5 years, whichever's longer. And if I do that, I can take my money out earlier. There are 3 calculations that they use to calculate how much you can take out of your TSP with no penalties up until 59 and a half. Unfortunately, if you're in the TSP, they only give you one option for the calculation. If you're looking to maximize how much you can take out during your go-go years, as a lot of people describe them, you're typically going to want to move that money to an IRA, where you have all 3 options, and you get to choose the option that is best suited for your ultimate needs. Very similar to VERA is DSR. The only difference is they're getting rid of that job description going forward. And with them getting rid of that job description going forward, it may leave holes in the underlying office or department that may or may not be needed. Nothing else changes. The Voluntary Separation Incentive Program. This was in many cases, and it was by an agency to agency basis, this was used in conjunction with the VERA or the DSR. And basically what it allowed you to do is, from a legislative standpoint, they could give you up to $25,000 to resign or retire, in addition to the other benefits that they've been waving in front of you. At the end of the day, we saw about, after September 30th, somewhere in the neighborhood of about 12.5% of the federal workforce ultimately resigned or retired, taking advantage of all of these large carrots that were dangled in front of them. And then we have a different group of people who are part of the reductions in force without the ultimate carrot. Now, these are people who were forced out, and we saw that in certain agencies more so than other agencies. In many agencies, a lot of the reductions in force was done voluntarily, which for many people was good news. But then we saw the Department of Education, USAID, Department of State, Department of Energy. All of these saw reductions in force that were involuntary. These definitely put a lot more pressure and strain on the underlying employees' stress level, as well as their financial plans. So there's 2 types of getting pushed out when you're not fully able to from a retirement standpoint. And just as a general reminder for everybody, in order to get your full FERS retirement or CSRS retirement, you have to be minimum retirement age with 30 years of service. For FERS, you can also retire fully with 60 years of age and 20 years of service, or 62 years of age and 5 years of service. You meet those thresholds, you are able to retire with an unreduced pension and immediate and permanent federal health benefits. But what happens if you get pushed out or you leave before that? So the first one, and this is the better of the 2, is called postponed retirement. This is for people who've reached their minimum retirement age, but they did not have the number of years of creditable service. They had less than 30 years of creditable service. These people can take their pension immediately with a 5% reduction of that pension per year that they missed the cutoff. And they're able to take their FEHB plan or the health insurance plan as soon as they start receiving their pension. If they so chose, they could wait till they become fully eligible for their pension. So let's say they have 22 years of service and they're 58 years of age. If they want to reach the age 60 and 20 years of service threshold, they can wait 2 years, and ultimately they can then turn on their pension and then turn on their federal health benefits. We saw a lot of people choose to do that, and they would use COBRA for 18 months. That allowed them to use the federal health benefit, but they'd have to pay for it in its entirety with no subsidization. And that got them through the health insurance need until they were able to take the unreduced pension. The great thing about the postponed retirement, you're going to be over 55, so you can take your TSP fully with no penalties. The next one, and this is not as good, and it's not as good primarily because you don't get to continue the federal health benefits. You get no subsidized benefits. You're going to be relying a lot more on either a private sector insurance or Medicare Part A and Part B, and probably an Advantage plan. And the difference is now people are trying to take their pension without their full retirement age or minimum retirement age hit. If you don't hit your minimum retirement age, you must wait until you hit the threshold, whether it be age 60 and 20 years, 62 and 5 years. And once you hit that, you can start taking your pension. And you can choose a survivor benefit. But you cannot choose a survivor benefit while you're waiting to take the pension. And there is no reinstatement of health or life insurance benefits. And again, for those people retiring before the age of 55, the TSP is not available in its traditional sense. All right, so the big difference, and it is a big difference, primarily it's health insurance. As I mentioned before, the federal government can subsidize up to 75% of your health insurance costs. That represents a great deal of money and a great deal of protection. If you're over minimum retirement age, you are eligible for a postponed retirement. If you're below that, you are not. All right, so we've talked to hundreds of people at GEBA in the process of making decisions. Back in April, we talked to them about the fork in the road. And more recently, we've talked to people making decisions who were offered VERA, who were offered DSR, and for people who were being forced out due to involuntary rifts. And the interesting thing, primarily for people retiring voluntarily, is about half of those people were already planning on retiring in the relatively near future. This just pushed up the timeline. The eligibility for a full unreduced pension, taking a little bit earlier, that was enough for them to move forward. The plan's already in place, everything's working. They'll probably check in on the plan in a couple of months, but they're good. The other half that we're seeing are people who saw a offer that was too good to be true, and they took it without really thinking through the nuances of the financial plan. They just knew it was a good deal. I can retire in February and I get paid until September 30th, for instance. And those people are now looking at their options. Now, the great news for federal employees is even if you were not planning for your retirement, you were kind of planning for your retirement because you have this pension that was growing, you have the Social Security that was growing, and you had your TSP match that you were probably contributing to. And that was giving you the basis for a very good financial plan from a funding standpoint. Now the question is, what does it look like going forward from a true financial planning standpoint? And that's what we're helping a lot of our members look through now and over the next month or two. All right. We talked about the FERS annuity, so let's quickly just talk about what it looks like. Those are for people hired after December 31st, 1983. It provided a 3-leg system. You had your pension, you had your TSP, and you had your Social Security. The TSP was provided with a match, which effectively was a total of 5%. There was a survivor benefit on the pension. 50% for your survivor is going to cost you 10% of your unreduced pension. 25% cost you 5%, and 0 cost you 0. The calculation is very simple. Your number of years of service times your 3 highest paid years times the percentage. If you were over age 62 with 20 years of service, that percentage was 1.1%. If you weren't, that percentage was 1%. Quick example, we have Sean Jones, 30 years of service, age 62, eligible for 1.1%. Average of his 3 highest paid years, $100,000, 1.1% times 30 years of service is 33%, times $100,000 is $33,000 in pension, and then subject to ultimately cost of living increase adjustments. All right, a next nuance. If you retire before the age of 62 fully, you are eligible for the Special Retirement Supplement, or the FERS Supplement, or the Social Security Supplement. It's been referred to in those ways interchangeably for years. What it means, though, is it's money that bridges the gap between your full retirement and when you're eligible to take your Social Security at age 62. At 62, whether you take Social Security or not, it stops. And while they tried taking it away during the reconciliation bill, parliamentary procedures in the Senate ultimately did not allow them to vote on that. So it was dropped from the House's passed bill. So what does it mean? So we have your age 62 benefit, and then you take your number of years of service, you divide it by 40, and that's ultimately your benefit going forward until age 62. As a quick example, we have Jane Smith, FERS employee, will retire with 30 years of creditable service. She has reached her minimum retirement age, which is 57. She's eligible for the Social Security supplement from 57 to 62. You take her age 62 benefit, $1,200. You take her years of service, 30, divided by 40, and you receive a FERS supplement of $900, not subject to a cost of increase adjustment, but money coming in until she's age 62. Next, we have Social Security. Social Security takes into account the highest 35 of your highest paid years indexed for inflation. You must work for at least 10 years. It used to be 40 quarters. Now it's 40 credits. For every $1,407 that you earn, you get a credit, and you can earn up to 4 credits in a given year. 10 years gets you eligible for Social Security. Now, one thing I do want you to focus on is the longer you wait, the larger your Social Security benefit is. Now, this slide, and I apologize, is a little bit dated. Most people on this call will not have a full retirement age at age 66. They will actually have a full retirement age at age 67. It's going to be those people born after 1960. For those people with a full retirement age of age 67, if you take it as early as 62, you're going to get 70% of your full retirement amount. You can wait as late as age 70. You're going to get 8% credited for each year after your full retirement age, and you can receive up to 124% of your full retirement Social Security amount. Now, how do you receive this money? Well, you can receive it on your earnings. You can receive it up to 50% on your spouse's earnings, or you can receive it on your deceased spouse's earnings, or even potentially your deceased ex-spouse's earnings. Now, as a survivor benefit, you can only take one benefit, the higher of the two. And because of that, if there's a large discrepancy in your age or health with your spouse, it generally makes sense for the person, the breadwinner of the household, to wait until age 70. Not only does it provide money in the later years with a break-even point somewhere in the mid-80s, but it also provides effectively free insurance for the person left behind. All right, so things to consider. There's been a lot of talk in a lot of different avenues, and Social Security is no different from a lot of the other legislative changes and fiscal policies that have been thrown around. There's been a couple of changes talked about on Social Security. The first one is the potential for reductions to Social Security as the Social Security Trust starts diminishing the amount of money that they have in stores. And at some point in time, the amount of money coming in through payroll taxes is not going to be enough to cover the promised benefits. Even after some of the people who were removed from the Social Security payroll earlier this year. It is currently estimated that about 81% of the promises, as things currently stand, will be delivered on from a Social Security standpoint. The other thing that was mentioned was the idea that right now, for those higher earner people, most federal employees are higher earner people, 85% of your Social Security benefit is taxable at your ordinary income tax rate. There's discussion about eliminating that rule and paying for it by making people pay for Social Security at higher income brackets. Right now, you're going to pay your Social Security tax up to about $170,000 and change. They're talking about bumping that up to $250,000 and then eliminating the tax on Social Security. Time will tell what, if anything, is going to be implemented, but I can tell you that there will be changes to Social Security. The question is it voluntarily through legislation, or is it involuntarily when the trust runs out of money? So we're monitoring this because obviously this is going to have an effect on your underlying financial plans. Managing risk, another important, very important part of your financial plan. As you enter retirement, there's a lot of risks that are important to be managed, but the two really large risks are long-term care, high probability, high cost, high duration, and health insurance. There will be people who life insurance still makes sense if you choose not to accept, let's say, a survivor benefit, or you choose not to use Social Security as a way to back into coverage for your child, or excuse me, your spouse. All right. So the last leg of the underlying retirement stool. So first leg was pension, second leg was Social Security, third leg is that thrift savings plan. Now the thrift savings plan is where most federal employees maintain the vast majority of their investable assets. For those under 50, they could put away $23,500. For those over 50, you could do up to $31,000. For those age 60, 61, and 62, your catch-up actually increases from $7,500 to $10,000. That's part of the Secure Act 2.0. You get the match. Match is always free money. Take advantage. And then you have access to a number of the investments. Now, the thrift savings plan is relatively simple. You have 5 underlying funds and then target date funds, which are built from those 5 funds. So you have the C fund, which is the S&P 500, the S fund, which is effectively a mid-cap fund. You have the I fund, which is international minus China minus Hong Kong. And then on a lower risk level, you have the F fund, which is corporate bonds, and then you have the G fund, which is effectively the 10-year treasury yield. You put all that together, that is how many federal employees build their portfolios. Over the last couple of years, they did introduce the mutual fund window, which does allow you to reach out at the mutual fund marketplace and invest and maybe potentially round out your portfolio. You need at least $40,000 in your TSP in order to do so. Another thing that people always ask is, which is better, traditional IRA or Roth? As a general rule, if taxes don't change and you have no need to pass money to your heirs tax-free, there is no difference. If you're paying a higher tax rate now than in retirement, you're going to want to not pay taxes today. If you're paying a lower tax rate now than in retirement, you're going to want to pay taxes now and take advantage of the Roth. And federal employees are also going to have other investments at their disposal depending on many things like inheritance or the level that you worked at within the government. At the end of the day, the things to consider is you want to understand what your total overall portfolio has, taking into account your TSP as well as any other investments that you have at your disposal. And you want to create a portfolio that's properly diversified, that's at the level of your risk tolerance that you're comfortable with so you can ride out the market. And a portfolio that's designed for your investment time horizon. So when you need the money, there's enough money that's safe sitting there to protect you from the market's ups and the downs. Because what we know, and I'm going to introduce Brian Duffy in the next minute or so, and what he's going to talk to you about is a good diversified portfolio is going to be able to weather the ups and the downs. And a good diversified portfolio is going to put you in a position where you can ride out the market, because time is one of the most important things when it comes to investing. As we lengthen the time, the risk goes down. All right. So at this point, I'd like to introduce Brian Duffy. So Brian Duffy is a portfolio specialist for Morningstar, and he's been nice enough to speak to us for about the next 30 minutes on what he's seeing in the market with all the expertise with Morningstar, which most of you hopefully have heard of them behind him. So Brian, I'd like to pass the mic over to you, and give me 1 second as I pass the mic.
All righty. Yeah, thanks very much, Greg. And good evening to all the folks on the call. I hope you are enjoying your evening thus far, and you're hopefully getting some good information out of this. And I'm very happy to be here, and I'm going to talk a little bit about kind of what we are seeing go on with the economy right now. Talk a little bit about the uncertainty. Talk a little bit about how the markets have responded to some of the things going on, and then we'll also talk about how we're thinking about constructing a multi-asset portfolio here at Morningstar to give you some color on where we think the opportunities are. So I will go ahead and share my screen here. Hopefully everyone can see what I am looking at.
We can.
Sounds good. Just want to put this into, okay. All right. So, broadly speaking, what are we seeing go on from an economic standpoint? Well, if you look at the tariff situation, it's super uncertain, right? I think tariffs in and of themselves aren't the most complicated thing, but when they're continuously turned on and off, it's really hard to model with any sort of precision or certainty. And I think that is the biggest challenge here. And so, I don't want to say take this with a grain of salt, but this is the current structure of what we're seeing with tariffs as it stands today. Tariffs have gone up meaningfully relative to kind of what we think of as sort of the average tariff rate. So historically, the average tariff rate has been about 2%. In terms of where we are right now, it's much higher than that. It's, call it 18 to 20%. This is as of August, so call it 18. With that being said, understand that things can change dramatically. Of course, the Supreme Court is reviewing a few things, and their ruling in November may make the tariff situation come down moderately. But then, of course, we had a series of new tariffs turned on not too long ago. So when you think about furniture, large autos, pharmaceuticals, etc., those actually have higher tariffs on them now. And so net, it's kind of hard to see what the current impact of both of those things are. But I would say for the purpose of this conversation, tariffs as they stand right now are meaningfully higher than what we've grown accustomed to. And so when you think about higher tariffs against sort of the economic backdrop, there are a couple of different implications that go along with them. To kind of zoom out and think of the big picture implications, when you think about economic activity and GDP growth and sort of sustainability of growth moving forward, that is where tariffs kind of negatively impact things. It slows economic activity down. It can slow growth down. Also, with tariffs sort of increasing the prices of things along the value chain, it puts upward pressure on inflation. So you've got this dynamic of slower growth, arguably negative growth, and then you have upward pressure on inflation. And so those are somewhat competing forces in terms of how the Fed kind of tackles those issues. With the negative growth story, the Fed will generally adjust the short-term rate down to kind of stimulate growth as it's, generally supportive of a number of different asset classes and growth in general. But to combat inflation, when inflation's stubbornly high, the Fed will keep rates high or increase them even more to kind of fight against that inflation. And so with these two sort of opposing forces kind of, at one another right now, you kind of have to take inventory and you have to say, okay, which side of the equation is moving the needle a little bit more? And I would say from our perspective, and probably from the perspective of the Fed and I would say the perspective of most other market participants, the negative growth concern is a little bit more of a needle mover in this particular point in time. And so when you think about the probable path moving forward of interest rates, because of those growth concerns, because of those economic activity concerns, we see a downward sort of path of interest rates moving forward. That creates a lot of opportunities from an investment perspective. When you think about, stocks largely, lower rates are supportive of stocks in a variety of different ways. And then when you think about the bond side of things, interest rates are directly inversely proportional to bond prices. So as interest rates move down, that is supportive of bond prices. And so when you think about equities and fixed income, a lower rate environment is supportive for a variety of those asset classes. And so you can see here, from our perspective, we do see the short-term interest rate kind of, coming down to about 3%, give or take, by the end of, call it 26, going into 27. And so relative to what we've experienced over the last couple of years, relative to the more recent average, that is dramatically lower. And again, that will open up a lot of opportunities from an investment perspective. Now, those are the big things kind of going on from an economic backdrop standpoint. There's a lot of uncertainty, right? And then you throw in this wrinkle of, the government shutting down. That has implications as well. I would say, broadly speaking, the market tends to look through some of the government shutdowns because historically they've typically been kind of short-lived and the market tends to rebound quite quickly. Now, of course, you could make an argument that this time is a little bit different. I would say, perhaps both sides of the equation here aren't necessarily looking hard to find sort of a compromise. Everyone's kind of, digging their heels into the ground, so to speak. And then, of course, if you think about furloughs turning into a more sort of permanent reduction in force, there are economic implications to that. So I would say, I'm not an economist, but I would say that the net feeling of right now is that it's not good, right? But generally speaking, using history as an example, the markets have typically looked through this. And so, similar to kind of how the markets have looked through government shutdowns, the market has looked through a lot of the uncertainty this year, for better or worse. And so you can see here, this shows the asset class returns year to date through the beginning of September. This is as of September 10th, so not too long ago. And so you can see here, despite all the uncertainty and despite all of the noise that's going on from an economic perspective, the asset class returns are quite strong. The S&P 500 index, which is broadly the large cap US equity market, that's returned over 12%, year to date. From a market cap perspective, large companies have done a little bit better than small and mid-sized companies. Growth as sort of an investing style has been in favor over value. And then when you look down to the international equity space, I don't want to say this is totally surprising because, our models have been saying this has been a great opportunity for quite some time. But I would say relative to kind of what we've experienced, more recently, the international equity space has delivered exceptionally strong returns. And so you can see here, the developed market measured by the EFA index has returned nearly 24%. I think a couple of things are going on here, right? General uncertainty around the US and the viability of the US economy moving forward. People are a little scared with kind of just how quickly policy can change. And I think, people are looking for sources of return and stability elsewhere. And I think that's why a lot of people are perhaps looking more towards international companies than they have before. Also, the valuation level, the starting point right now for international exposures is much more reasonable relative to the US. So the US has been the place to be from a global perspective for quite some time. And the return story has been fantastic. But with that really good performance has come a heightened level of valuation. And that's, basically a bad starting point for future expected returns. And so, when you look at the international space, there's just a much more reasonable starting point, if you will. And so I think that's kind of baking into things here. And then also, when you look from an international equity perspective, obviously currency plays into this. And given the uncertainty around the US over the last few months in particular, and after a really sustained strong run of US dollar appreciation over a number of years, we've actually seen the US dollar come down quite materially over the course of this year. And from the perspective of an international equity investor, that's supportive of international equity returns. And so you've got those kind of three major things baking into a really nice return story. Lastly, with fixed income quickly, you can see here, across the board, positive returns. I would say relatively speaking, compared to equity markets, not as high, but that's to be expected considering the level of risk with fixed income is broadly lower than what you'll see in the equity markets. But within fixed income, it's a similar story in that sort of the riskier areas of the market have tended to outperform. And so when you look at things like corporate bonds, high yield bonds, emerging market debt, so on and so forth, those have outperformed at the margin. But by and large, it's really been a fantastic return story for most major asset classes. And I think this underscores the resilience of the market. And I know Greg talked about, sticking to a long-term plan. I will have some other slides at the tail end of this presentation that I think are pretty compelling with that. But, this goes to show that despite everything that's going on and everything can feel a little doom and gloomy, right? The market tends to be pretty resilient. And so you want to experience these returns when they happen, because it can be pretty detrimental to your long-term portfolio value if you miss out on these really good times. And so again, I think this is important for context. What are we seeing from sort of a broad equity perspective? Well, I think the dynamic of the market is shifting, largely speaking. And so when you look at sort of what's driven market performance over the last few years in particular, I would say most folks on the call have probably heard of the Mag 7. It's a handful of kind of growthy tech names that have almost single-handedly carried market performance. There's just a few names that represent a really large portion of how the index is kind of allocated, if you will. And so these few names represent, at one point in time, it was over 40% of the index. So it was like, if you were invested in the S&P 500, for instance, your performance was largely dictated by what just a handful of these stocks were doing. And so for a long period of time, people thought, essentially these stocks couldn't lose, right? And so we're starting to see a little bit of an unwinding here in terms of this really strong performance. Now, the big names like the Meta, the Microsoft, the Nvidia, they've still delivered really strong returns, not quite as strong as they've delivered over the last 3 years in particular, I'd say. But I would say something that's different about how this year has played out versus other years is that sort of cross-sectionally within this bucket of stocks, we've actually seen not every name do well, right? So at one point in time, halfway through the year, Google was actually down somewhat materially. Apple was down materially. Tesla was down materially. This is reverse course a little bit, but even with some of these names kind of, bringing in modest returns at this point in time, they're nowhere near what we've kind of traditionally seen over the last few years. And so when you think about, again, the implications of that, that's suggesting that the market is starting to kind of unwind and, basically money is pouring into other parts of the market that haven't traditionally done well. What does that mean for you who's, trying to figure out how to allocate your portfolio? Well, I would say that, if you have a portfolio that is well diversified right now, that is balanced across a variety of different exposures across the market, that portfolio is poised to benefit from this kind of concentration unwinding, because instead of the market sort of favoring one very narrow segment, other parts of the market are starting to do well. So I think it's important to keep that in mind as we kind of go forward here. And so you can see here this dynamic at play during the first half of 2024. The S&P 500 return was about 15.2%. This is from a market cap weighted perspective, so not equal weight. When you compare this against an equal weight, so all of the constituents having the same weight in the index, that return was only 5%. Again, this was the first half of 2024. So about a 10% spread between an equal weight and a market cap weighted return. What you'll see here in the first half of 2025 is that disconnect and that spread has narrowed considerably, right? So the market cap return is about 6% and the equal weighted return is about 4.6. So again, that huge disconnect is not there. And again, that suggests that things are starting to kind of even out, and other parts of the market are being rewarded in a way that they haven't been for the last few years. When you decompose the equity market, looking at the S&P 500 year to date, you can see, of course, the heavy hitters, the comm services, the technology, the industrials, those have typically done well over the last several years. Those continue to do well. But instead of seeing the rest of the market return essentially zero, you're seeing a lot of other parts of the market, return kind of, I would say pretty solid absolute level returns. So if you look at the more kind of defensive leaning exposures, whether it's utilities, materials, to a slightly lesser degree, perhaps you could throw energy in there a little bit. Those are still returning, in some cases, solid double-digit returns. And so again, when you think about the areas that typically haven't done as well, historically speaking, over the last, call it 5 to 7 years, some of these areas are really starting to shine. Broadly speaking, what are we seeing from kind of an overall view of the US equity market? Well, it's expensive, right? Again, as I mentioned before, really good performance is a nice thing for looking at your statements and portfolio values and all the things that come with that. But when you think about the implications of a really high level of valuation, and again, this is measured by what we call the price to earnings multiple of the market, sort of gives you a sense of how expensive it is. The higher that multiple is, the worse the outlook is for expected return in the future. Because if you think about the level of valuation as sort of the jumping off point, the starting point, all else equal, when you've got a really high level of valuation, there's not as much upside room and there's more downside risk. And so I think that's an important thing we take into account when looking at the US equity market in sort of total right now, is that there's just a lot of potential valuation risk embedded in here. And so to give you a sense of just how extraordinarily high the valuation of the US equity market is, you can see here that the most recent multiple is just over 22. May not sound like much, but to kind of contextualize this, the average multiple going back in time is about 16. So from a percentage perspective, 22 is well above 16. And to give you a sense of how high the multiple was, just before the dot-com bubble burst, it was at 24 and a half, right? So I'm not calling for a bubble to burst per se, but to give you a sense of just how highly valued the US equity market is, it's almost near at all-time highs. And so from our perspective, this is something that we look at closely, and we're still going to have a healthy amount of US equity exposure, particularly in our multi-asset models. But instead of having a huge amount just dedicated towards the US equity market, we're going to look towards other opportunities that have a better jumping off point or a better starting point. And so that leads us into kind of where we see some of the opportunities. And so when you look at the expected returns in the future, so this is based on our models that we have here at Morningstar. It provides an average 10-year expectation for various asset classes. And so you can see here that the average 10-year return that we can expect out of the US equity market is just over 6%. For developed and emerging markets, respectively, it's at 8.4 and 10.9, right? So when you just look at the return differential there, quite a sizable difference. Much higher returns can be expected out of international markets right now. And so we think there's a lot of opportunity there. And again, we're not advocating, okay, take your entire US equity portfolio and move it outside of the US. Like that would not be prudent from sort of an overall risk perspective. But the way that we think about it is, okay, we've got a benchmark. That's sort of our North Star. That's kind of what we tether to. We have views that may be different than the benchmark, right? And so what we're going to do to express those views is that we're either going to lean into a certain opportunity a little bit more than the benchmark, or lean away from another opportunity more than the benchmark, right? And so when you look at how our multi-asset portfolios are positioned, we're largely neutral from an overall kind of equity bond perspective. We're not taking material risk one way or the other from an overall kind of asset class perspective. But underneath the equity umbrella or underneath the hood, we are leaning into the international markets a little bit more. So we're actually, call it 4 to 5% overweight international right now, and we're actually underweight US, right? And that is purely a function of kind of where we see the valuations are. US super high, non-US a little bit more reasonable. And then when you look at the expected returns are much higher outside of the US right now. Within the US, right, this is where we kind of make slight tilts relative to our benchmark as well. Of course, the overall market is high, like I said, but cross-sectionally, there are opportunities here. And so when you look at the small part of the market in particular, the levels of valuation there are much more reasonable. You can see in the large part of the market, particularly in large cap growth, things are trading at, call it 11% in the growth bucket of the large cap area, 11% over what we think their fair value is. But if you look to the smaller part of the market, small cap value, small cap core in particular, you can see that these exposures are trading at, call it a 20% discount to what we think their fair value is. And so when we think about how to allocate within US, we're going to lean towards the areas that have a little bit more of a valuation opportunity. And for this reason, we are overweight small cap in our models. There's just a lot of upside there, and you can make a really strong case that there could be some significant tailwinds for small caps, which I'll get into in a minute. Looking at this particular slide here, I think this illustrates the tailwind potential, right? So, what we've done here is we've basically looked at what is the sensitivity of both small caps and large caps relative to changes in monetary policy. And so basically what we've done is, we've taken like a really short-term interest rate as sort of a proxy for Fed fund policy. And we've looked at sort of historically how the returns have, for each of these asset classes have measured against that short-term interest rate in terms of sensitivity. And so what you can see here is that small caps tend to be way more sensitive than large caps. And so when rates go up, small caps get hurt a little bit more. But when rates go down, small caps tend to outperform, right? And so again, when you weigh the probabilities, when you look at everything that's kind of going on in the world right now, you could make a strong case that we're still going to see a downward sort of path as it pertains to interest rate movement. And that's another reason why we have this small cap overweight right now. So the valuation story is there, they're on sale, but then they're also super sensitive to interest rate movements. And when you think about the implications of a downward interest rate movement, could be a nice story for small caps in particular. And so to kind of sum up our sort of high level views here, you can see, again, as I mentioned, we're neutral equity to bond, right? So we're not going to be, if we have a 60% equity target allocation, we're going to be right at 60%. We're not going to be over or under. But within equity, we're going to be underweight US, overweight non-US due to that valuation opportunity. Within fixed income, and I think fixed income is a really interesting opportunity really across the board because the dynamics have changed so much there. So when you look at fixed income, broadly speaking, we went through a lot of pain when rates went from, call it 0 to 5.5% at the front end of the yield curve in a very short period of time. But what that did was it brought income back into the equation, and it also provided sort of a much needed valuation reset for the opportunity, broadly speaking. And so when you look at fixed income overall, really compelling opportunity right now, and the high rates that we're experiencing right now, that is actually building in what we call an income cushion for fixed income. And so I won't get into the mechanics and the weeds of it, but basically because rates are high right now and you're getting sort of an income cushion, that helps to insulate price risk due to what we call bond duration. And so the point being here is that it's a really unique opportunity for fixed income right now. And we're really kind of bullish on fixed income overall. But within fixed income, again, we have different views that we're going to express. And so when you think about sort of the more kind of traditional safe haven government treasury type exposures, those are the areas that we're leaning into. And we're actually leaning away from the areas that tend to be a little bit more expensive right now, whether it's emerging market debt, high yield credit, investment grade credit, so on and so forth. And so to kind of sum things up, key takeaways, and then I'll get into kind of the compelling sort of the compelling reasons to stay fully invested in the markets over time. Volatility is going to be something that unfortunately we have to deal with, right? I think there's just so much uncertainty in the world that it's something that is going to come and go, and it's just going to be a part of our day-to-day lives. There are opportunities outside of the US, contrary to probably popular opinion, as I mentioned before. Fixed income overall is a really compelling opportunity right now because the dynamics have changed so much. And again, we went through a lot of pain with interest rates going up. Now that creates a really good starting point for fixed income allocations. And again, if you think about the path of rates moving forward, that would be supportive of fixed income prices, largely speaking. And of course, we can't change anything that's going on in the world right now. The best thing to do is kind of, look to the plan that you constructed with your advisor during a normal time, right? During a normal environment. This is meant to be your North Star. This is something that you want to tether to. We are certainly staying the course and sticking to our long-term plans. And so, as an individual investor, I think that is probably the best course of action for you guys to do as well. And just to give you a sense of how important it is to stay invested, you can see here, this shows the S&P 500 performance over time dating back to 1926. It's the growth of $1. So $1 invested in 1926 has turned into about $19,000 today. Of course, that's great. That's why we invest. We want to, earn more in the future. That's what compounding does, all of that good stuff. But I think this is unique. This exhibit is unique in the sense that it overlays all of the stuff that has gone on historically, right? So you see crash of 29, World War II, Vietnam War, 70s stagflation, so on and so forth. All of the shocking events that we've gone through, and the market continues to climb over time. And so the point being is that something is always going to come up, something is always going to happen. Don't let that disrupt your investing kind of path and journey, because the market will kind of carry on without you if you don't want to invest, and you don't want to miss out on something that continues to climb over time. In that same vein, you can see here, this shows the hypothetical of a $100,000 investment going back to 2008, right? So think of the market crash and then investing $100,000. The blue line represents a fully invested portfolio. The purple line or the red line, however you want to look at it, that represents an investor who went to cash for 1 year and then invested fully 1 year after the market crashed and stayed fully invested. And then lastly, the kind of gold line, you can see someone who stayed on the sidelines in cash the entire time. It's not even close. Far and away, the best outcome is the fully invested portfolio. You can see that 100,000 back in 2008 is at about 1.2 million now versus the investor who was all cash is at about 152,000. So significant difference in outcome. And I think it underscores the importance of letting sort of investment compounding work for you. Last thing I'll kind of end on here, same sort of kind of point that I'm trying to drive home. It's really important to stay invested because not only do you want to experience the strong gains when they happen, but the problem is that, you know, when gains do occur, they tend to cluster together, right? And so the best few days tend to kind of fall next to one another. And so if you miss one day, you're going to miss a few days, right? Inevitably, if you're trying to time the markets. And what you can see here is that if you stayed fully invested over time, $1,000 investment after 25 years would have, you know, you'd essentially have almost 6 times your money. Whereas if you missed even 40 days, think about that, 40 days over the course of 25 years. I've actually done the math on this. Over 25 years, there's 252 trading days in a year. That's like 6,300 days. If you miss 40 days of 6,300, 40 of the best days, I will say, that's like 0.6% of the time of being invested. You would actually lose money on that initial $1,000. So it really underscores and kind of drives home the importance of staying fully invested. I know from my perspective, I'm pretty risk averse. I don't like looking at the headlines every day. You know, I basically just, you know, to the extent that I can, I set it and forget it. And I just trust that the math will work out for me in the long term because, you know, I've tried at the margin to kind of time things when I think things are going to blow up or I think there's an opportunity. It typically doesn't work well for me and I stop doing it. So I advocate, you know, sticking to a long-term plan. I think all of the data here kind of supports it. And that's sort of what I would end on as kind of the biggest takeaway here.
All right. Brian, thank you very much. And just to give a little bit of additional information, Morningstar is one of our primary partners when it comes to the management of our clients and our members' money. They've done a very good job over the years. What they choose, the way they manage is understandable. It's systematic. And we like how clear and concise it goes from, you know, information to strategy to implementation. So with that being said, I just wanted to mirror one of the items that Brian said. He mentioned talking about risk tolerance and staying in the market for those 40 days. You know, keeping a portfolio with a risk tolerance that is comfortable is incredibly important. If you're uncomfortable in your risk tolerance and the market goes down, that's when you do things that historically have not proven to be the wisest decisions. So getting invested in something comfortably is very, very important. Also want to point out, just from a disclosure standpoint, that I actually follow what Morningstar does from a personal standpoint. And I have started tweaking my investments to be a little bit more international, a little bit more emerging market, and a little bit smaller in cap size. And the last thing, which may be pertinent to the people listening. So if you're looking to invest in smaller funds inside the TSP, that's the S fund. If you're looking to invest in international within the TSP, that's the I fund. The big gains that have happened over the last 10 years, the S&P 500, that's the C fund. And the positive potential associated with interest rates and fixed income, if you're looking for something in the TSP, that's the F fund. Okay, so with that being said, let me just share my screen real quick. There we go. We are going to be moving on to questions. Now, I know some of you sent in questions when you enrolled. I have not seen any questions in the chat box at this point. If you do have questions from something that I said or something Brian said, please write them in the text box, chat box, and we will stay a little bit after just to make sure everybody's questions are answered. What we're also going to do is we're going to send a question and answer list to people who've attended the seminar, just to make sure your questions are fully answered. We'll be sending you a copy of the seminar as well as a recording. For those of you, as you start heading off to your evening events, please do me a favor and fill out the form as you're leaving. Our seminars, our webinars are only as good as the people who came before you, so we definitely take your insight and thoughts on what we talked about very seriously. All right, so with that being said, let's just talk about some of the questions that were sent in. So one of the first questions talked about the 4% rule. So the 4% rule, what it was, and it was something that was designed back in the early 90s. They basically said that based on Monte Carlo statistical analysis, that if you have a 60% equity, 40% fixed income portfolio, you could withdraw 4% per year. That would be an amount that would be indexed for inflation, so it would go up every year, and you would have a 91% chance of your money not running out over a 25-year period. That's the math. When the interest rates were very low, there was talk about revisiting that on the downward level. I just read an article about a month ago where that person who originally came up with the 4% rule revised that rule to say it's going to be 4.7 to 5.2%. based on the current interest rate environment. So if you have $1 million, that $1 million is going to give you, index for inflation, somewhere between $47,000 and $52,000 per year, just as a general back of the envelope rule of thumb. All right. Next item. Do attendees receive a financial report? Well, if attendees want to talk to one of our financial advisors, you are absolutely eligible for a financial report. You will receive a copy of the slides. You will receive a copy of the presentation. And as members of GEBA, you will absolutely receive help from a financial advisor, certified financial planner. Whatever your needs are, we are happy to help. Okay, I'm trying to buy back my military service now, and I'm told it'll take a long time. It will, and there's nothing they can do about it because they've limited the number of people who are processing those. Now, with that being said, military buyback is very interesting. It can make sense for people who are looking to buy back military, who are eligible for pension, and who are looking to increase their civilian pension. But it only makes sense when there's a very, very large discrepancy in earnings between the military and the civilian federal employee. We have a calculator that we use that actually helps us determine that. To be honest, about 8 out of 10 times, it doesn't make sense to buy back a pension or buy back military service if you're receiving a military pension. Now, with that being said, if you went to an academy, in almost every situation, it makes sense to buy back those 4 years. They're incredibly cheap, and they don't count towards your military pension, but they absolutely can count towards your civilian pension. All right, how strategically to use traditional and Roth TSP to building one's portfolio. This really is a play on taxes and legacy planning. If you're going to be making more money, if you're paying more money in taxes now than when you retire, you're going to want to wait to pay taxes until when you retire, which means you want a traditional side, a traditional IRA or a traditional TSP. If it's reverse of that and you plan to pay more money in taxes when you retire, the Roth typically makes more sense. Now, the one key item that to pay attention to that's above and beyond taxes is if you don't want to have to spend your money, the Roth has value because there's no required minimum distributions. If you want to leave money to your heirs, the Roth has value because your heirs do not have to pay taxes. But if you're planning on spending the money in retirement, it is purely a tax play. All right, and I still see no questions in the chat, so I'm just going to follow the rest of the list, which will take about 5 minutes. All right. Can you go over in detail examples of tax implications if I withdraw $3,000 a month from my TSP? Well, $3,000 a month is $36,000 per year. It's going to be taxed at ordinary income tax rates, provided you retired at age 55 or later, and there'd be no 10% penalty. And depending on which tax bracket you're in, taking into account your Social Security, your pension, and your withdrawal, that's ultimately the tax bracket that you're going to be paying those taxes. So we're happy to do the calculations for you, but there's a lot of tax brackets out there, so we're not going to go through every single tax bracket. All right, what will happen to my retirement pension when the government shutdown? Your pension should get paid. If you're getting Social Security, that should get paid. The government shutdown should not stop either one of those items. If you're still a federal employee active, your paycheck will be delayed. Now, the one piece of good news is there was a law passed in 2019 that said that if you're furloughed, you're going to get back pay by law no matter what. So provided the shutdown ends, which at some point it will end, by law, you will get paid back. Now, the question is, do you have the liquidity to protect yourself in the short term? Are you living paycheck to paycheck, or do you have enough money in savings to ensure that you don't have to worry about a liquidity need? Back in 2018, 2019, that was a concern for people because we had actually crossed into a third payroll cycle while the furlough was in place. But as long as you have savings, you should not have an issue. All right. Can Brian or someone speak to the sequence of return risk and how to mitigate? So Brian, I'm going to pass that one to you.
Yeah, sure. Very, very good question. So sequence of return risk is basically the risk of the market not doing what you need it to do at a certain point in your life, right? So in other words, you've built a portfolio over a long period of time. Let's say you've had like an 80-20 allocation, so 80% equity, 20% fixed income. You're getting to that retirement age, right? So say you're hypothetically, I don't know, 58 years old, right? But you still have that 80-20 allocation. And let's say the market corrects violently when you're 58 years old and it draws down sharply, right? That is called sequence of returns risk. Like you hit a sharp drawdown exactly at the point where you don't want to hit that because you just don't have the time in front of you to make up those returns as you did when you were 25, right? So that's largely sequence of returns risk. How do you mitigate that? I think there's a couple of things. Diversification. To sound obvious or not sound too obvious, I should say. Diversification is huge, right? So spreading your risk in a lot of different buckets, being regionally diversified. So having U.S. non-US, emerging, so on and so forth, type of exposure. You want to diversify based on cap spectrum. Like I said, you want large, middle, small. You want growth, you want value. You just want to spread your risk out so that not everything is moving in tandem all in the same way at the same time. So that's one way of kind of mitigating. The second way is to sort of, and if you're familiar with kind of how a target date fund works, is that you can invest in sort of a target date approach. You will have a higher equity allocation when you are younger. So you'll have a riskier allocation because you have more time in front of you. As you get older, you will incrementally change the allocation, right? So instead of having, call it 80-20 when you're 58 years old, you may have 40-60, right? So you have a higher percentage to like fixed income in your portfolio than equity. And so typically, fixed income risk is less than equity risk, all else equal. A variety of things can happen, which, can change that in certain circumstances, but broadly speaking, that's the rule. And so I would say that's the big thing is shifting from equity to fixed income or high risk to low risk assets as you age, and then also making sure you have appropriate diversification within your respective buckets.
Thank you, Brian. All right. So we'll just next couple of minutes, and then we'll head off to our evenings. This is kind of a broad-ended question. How do you determine if you have enough money to retire comfortably? Obviously, there's a lot of assumptions that are made in that underlying question. One of the key assumptions is what does your retirement look like, and how much is it going to cost? And once we have your budget in retirement, okay, what are the building blocks that we have to fund those? Your traditional building blocks are your pension, your Social Security, and your money. And Brian's done a really good job talking about, okay, how to appropriately allocate our money based on the current situation, the current market circumstances. As a general rule, adding up your Social Security, it's pretty straightforward. Go to mysocialsecurity.gov. You can get an estimate. You can get an estimate of your first pension, or you can calculate it, which is quite simple. Number of years of service, 1%, average of your 3 highest paid years. If you have age 62 and 20 years, that 1% goes to 1.1%. Add that together, apply a tax rate to it, and that's ultimately the amount of money that you're going to have at your disposal. We take the investments that we have, multiply it by about 4.7% to give us an estimate on what kind of income that our lump sum is going to provide. Or you can give us a call, and we're happy to do a financial plan for you, which is going to do all that math for you and on your behalf and take into account all the appropriate state and local and federal tax brackets. All right. Does GEBA offer life insurance for federal employees, especially with pre-existing conditions? I think the caveat is what kind of pre-existing conditions. There will be some that will not allow somebody to be insurable. And if that's the case, maintaining FEGLI makes a whole lot of sense. The truth is, though, I rarely see anybody bring FEGLI option B, which is the big one, into retirement past the age of 70 because it gets very, very expensive. But if you are in poor health and you're looking to cover your family in the short term, FEGLI, as long as you've had it for at least 5 years going into retirement, is definitely the place to start the thought process. If you have things that could not allow you to get group insurance, we do offer individual insurance that is a lot more flexible from an underwriting perspective. Cancer is not something that's going to wipe you off, but you're going to have to be clean for typically 5 years for most cancers, just as an example. All right, let's go with one more question. How long can I last with $60,000 in my TSP, the basic GS-12 pension, and Social Security? Well, again, lots of assumptions here. I don't know how many years of service you have, which is going to be a defining factor in the pension calculation. But I can tell you the $600,000 is going to give you about $28,000 in income for the rest of your life, indexed for inflation. Add that together with your Social Security and your pension, or come to us and we can do that. And that's going to give you the budget and the percentage of success that your assets, your pension, and your Social Security will provide. And then let's go with one last question. What is the level of effort or process to have my financial system evaluated in preparation for retirement? We just need information. If you can give us copies of your statements and information so we can calculate your pension, and a copy of your Social Security statement, that's going to get us 90% of the way there from a financial plan standpoint. So if you have that information at your fingertip, or you can download it, I would say the level of effort is rather minimal on your end. We are going to require about a 1-hour meeting so we can go over the financial plan. In some cases, it's going to take 2 meetings, depending on the complexity of your situation. Okay, I think we've covered all of the topics. I don't see any more written in. Brian, thank you very much. You clearly explained it incredibly well because there was only one question.
Very good. Happy to help out.
I appreciate it. For those of you who have further questions or want to talk about something more personal, you can see our information is on the screen in front of you. Please reach out to us, shoot us an email, give us a call. We were put on this earth back in 1957 to help our federal employees and our members, and we take that very seriously. So please let us know how it can help. Thank you. Have a great evening.